All right, this is Jeff Scott, and this is going to be, I hope, brief. It's late at night. You can see it's after midnight, although I'm on Central Standard Time, so it's not quite as late. I said I wasn't going to do this, but since I have my meeting coming up, I want to provide some service to the people that are put their confidence coming to my meeting. I want to do this just so I can keep them hopefully engaged with learning HGSI. I'm sort of intellectually challenged as to what I think is going to happen this week. Emotionally, after we made the recovery late in the day on Friday and didn't have as much of a bad day as it looked like earlier, I thought that we'd be going this week into a melt-up. And part of me still thinks we're going to melt up. Melt-up to me would be a rapid move up, multiple percent at a much higher rate, at which point the market will peak and roll over. Then I did my weekend review, and I think I got more concerned about meltdown. So I'm going to say that means I've got to be neutral as we start into this week. There's my email address. If anybody wants to contact me. Disclaimer, this is for education purposes only. Anything I recommend is in the spirit of education, not investment advice. I'm a doctor, not a broker. Keep in mind that most physicians lose money with their investments, and I am not affiliated with any software vendor or trading company. The tools I demonstrate are those that I use in my daily trading, and I have paid for everything that I demonstrate or that I use. Sort of my philosophy in teaching people and my philosophy in trading is that there's only one person out there responsible, maybe two, for your finances, you and your spouse. And if you don't have a spouse, you. You can trust others to manage your money. You could ignore them. You could manage them handily. Everybody's going to be different. But at the end of the day, some of its responsibility's got to fall on your shoulders. So, like most of you, frankly, like many of you, I'm a physician. I'm not I don't do this. I don't do trading education for a living. I trade for a living now, but I didn't make my fortune trading. I made my fortune in business. And I'm just in a position in life where I want to make sure that my nest egg lasts long enough to take care of my grandkids, who aren't even born yet, as well as myself and my children. And so it's important to me that I take responsibility. It doesn't mean I manage all my money. Frankly, I have a lot of outside managers. But at the end of the day, I'm responsible. And when I'm responsible, it doesn't mean I'm going to put all my faith and all my finances in the hands of a third party. I've got to take responsibility. So my thought is the best way to do that is to learn as much as I can, establish the things that create my own style and teach me and help me learn what to do, and then create my own. So rather than look at a guru and say, manage me, I want to become my own guru. And to me, you become your own guru by identifying smart people, going to their live meetings, reading their books, learning how they trade. And then we're individuals. We can take the best of what we learn from the various people and we can put that together into our own style. And to me, that's what this is about. I want to not teach you to be your own guru because I think that's something you got to do yourself. I want to stimulate you to want to be your own guru. These are some of the gurus that I pay attention to. Neil, Morales, and Katcher. I know many of you are fans of Gil and Chris. Ian and Ron, Alexander Elder, Bigelow for candlesticks, Minervini, Van Tharp, and one that I've added of late, Jesse Stein, who I forgot to put on this one today, but also John Perset. I think John has a very clear way of thinking. He has indicators that are already branded, incorporated inside of Thinkorswim, so many of you are using his pivots, and his books are excellent. And for those that are HGSIers, although he doesn't use HGSI, hopefully as I get to know John, I'm hoping to introduce him to it. A lot of the things that he does follow the same things we do, looking at some top-down approach, looking at the impact of the market, seasonality. He's a much better trader than I'll ever be, much more experienced, and his books are worth taking a look at. And for those of you that are coming to my meeting, sorry about that annoying box, you're going to get the opportunity to listen to him live because he's going to be participating with us, which is going to be great. He'll be speaking on Sunday. I own a lot of software. At the end of the day, I don't need a lot of software. These are the tools that I make my money with. my real-time trading program, which can be TradeStation or Thinkorswim. I use HGSI for analysis, and EdgeRater, which does a number of things for me. You see snapshots of it during every one of my weekend reviews, from helping me with market timing. Seasonal analysis, I'm a big fan. I use Magenta Trader and Best Choice and TradeMiner, and then MarketSmith. And I should also include Metastock. I think over the years, HGSI's charting module has really improved, but Metastock, for those of you that don't have Thinkorswim or TradeStation, offers an excellent real-time charting platform. But where they excel is they have a number of the masters that have created explorations and charting indicators that I can't get anywhere else, and that's part of why I keep Metastock on my computer. So as I looked through my review this weekend, more new highs. And not only that, but now we see momentum stocks and small stocks participating. I was fortunate enough to pick up Netflix as it was coming back over 300. I bought some 320 calls in a spread. I thought I was a little crazy because there were 370 on the other side of the spread. I actually had to cover them, and I flipped them into 430 calls. And I'm still long. Netflix was up on Friday, but I have to, at some point I got to take my profits and run off to the bank. Small stocks clearly have picked up. There's a wall of worry growing. We're starting to see perhaps some new damage in biotech. It's not unusual, for example, for biotech to start to sell off in the summer season after you get through ASCO, which is a big cancer meeting where I'm at right now. Clearly, I think the market's looking for an excuse to sell off. As I look through my chart review, interest rate sensitive stocks are in favor. Utilities, energy transmission, midstream plays, REITs look good. Anything with a dividend looked interesting. Packaging stocks, energy services, Halliburton, and others. There's some Weatherford also looked kind of interesting. And actually some of the regional banks, I think we call them national banks in their Bloomberg industry groups. I didn't see the JP Morgan and the Bank of America and the Citigroup getting me excited, but there were some Wells Fargo action and some other stocks below Wells Fargo that I thought were intriguing. So as I started to put together my own scorecard of melt up or melt down, from a melt up perspective, that's how bull markets sometimes end. They don't usually end with a whimper. I don't think we've seen a melt up. Perhaps we're seeing a melt up in certain sectors and certain stocks, but part of me expects a melt up before the market dies. Participation broadening, that's a good thing. You look at the S&P at about 19 and a quarter, and you realize that 2000 is 4% away. Isn't that a nice round number that the market might like to hit, trade above it, set a new target, and sell off? We still have QE continuing. I read something this weekend that suggested we'll see a big POMO month with Treasury purchases by the Fed. A lot of talking heads coming out on both sides, and some trying to make the argument that on a forward look, we're not at topping multiples, so maybe the market's not expensive. We still have a low interest rate environment, and it's kind of crazy because everybody talks about a top in bonds as well, and you're buying expensive bonds now because interest rates are so low, and I think that's partly why we're seeing utility stocks, REITs, and other interest bearing instruments go up, and we still have an accommodative Fed. What goes against a melt up? We've got bearish divergences on the major indices. They are nice signs, but they could occur for weeks before the market rolls over. I've never seen the VIX as low as it is right now. I'm not sure if it's an all-time low or at least a generational low. Market rallies start from a VIX that's falling from high levels. Market failure usually starts from a VIX at a very low. So it's not the end of the day until the VIX starts to rise, but how much lower do we expect? Then you look at things like the McClellan oscillator, which started rolling over. When I ran my high jump scan, I had a record number of stocks meeting the high jump. Now what does that mean? It means extended, that we have a lot of extended stocks. Talking heads calling that we're at a top. And then, didn't we have negative economic growth? That's not a good thing. And obviously everybody's blaming it on the snow and expecting that the next quarter will show us moving back towards 3%. But that's a big divergence in news and story, and hence why I'm a little confused. News drivers this week, I think the big one's going to be Friday on D-Day. Hopefully that won't be D-Day as a bad day for the market, June 6th, because we're going to get the payrolls. I'm in a number of energy plays, and the gas stocks, energy plays with gas, have done extremely well. I saw Range Resources and Devon make my big buy list from a opportunity. I saw some drillers showing up. There's been drawdowns, and not the buildup that people would like to see of natural gas, which means higher prices. A number of other things on the mortgage index, ADP employment change, that'll be drivers, factory orders, construction spending. I get this from Leave It Brothers. It's free. You register, you get some newsletters, and you get access to certain things. You also get the earnings. Now, I don't know if Hertz is actually going to announce. They've delayed their announcement several times, which, interestingly, they haven't sold off. Ambarella's been a Momo stock that's been hurt recently, trying to come back. It's got earnings on Tuesday after the close. And you can see others that, now I'm looking at this, and Monday is correct, but I'm wondering why Friday there are none. And I wonder, and I think NQ already reported, so I actually just took these from the website, but to be honest, I'm beginning to question some of these. So I wonder if there's an error here, because I wouldn't expect nothing on Friday. Con, I've had some in one of my portfolios, and it does report. So verify these before. Obviously, these are the right dates there. So let's take a look at the charts and see if we can come up with your own idea of what the market's going to do. Let's go first to TradeStation. These red dots are an indicator that I purchased from Alexander Elder. These are, and people know I like the Elder indicators, and recently went to a training class, one of his boot camps. And this is the bullish and bearish divergence indicator. And so he has an indicator which he calls it I don't know if he doesn't say it's definite, but it looks for a divergence in price in the MACD. And it's not exact, and so it starts to fire, and it should drive you to look. And so, as we start to look, we're going to see that we're firing the divergence indicator on the daily and the weekly on the ES, representing the S&P 500. The other thing that I look at on the high jump, we're at 82% of the highest in the last 200 bars, so not too high. We look at the color of the bars. They're green, so the buying window, as Alex would say, is open. You're at the top of the envelope, but to be fair, it's written up the top of the envelope before. You're green, and you're blue. So certainly you see the strength in the S&P 500. And look at this from March of 9, really straight up. So if you wonder why a lot of people are saying it's overdue, a bearish market, I think it's pretty darn clear. You can see the TradeStation isn't updating my portfolio there, so not everything's worth zero, I can assure you. But this has been an amazing move that we've been in since March of 09. If you look at the NASDAQ futures, you see divergences again on both the weekly and the daily. You see blue coming in. Now, blue is sort of indecision, where you do have the ability to do whatever you want. You could buy, you could sell, you could hold. The divergences are what I want to point out. If I look at the Dow, I see right in the middle divergences on the weekly, but green bars, so still supporting being long the Dow. And if I look at the NASDAQ, I see blues coming in at the top of the channel, green on the weeklies. I don't see the bearish divergence. You can see back here, you can kind of make out that they had a bearish divergence the entire way up on the weekly. Ultimately, the market sold off. Now, it's kind of like the sky is falling, eventually the sky fell. But we don't have a divergence on the weekly, which to me is more meaningful. So everything is blue or green. That goes along with enough to say I have a reason to be potentially be bullish. Let me see if the high jump scan is here that I was mentioning earlier. I run this scan on a weekly basis. I usually get 100 on a bad week. Of the potential for about 5,000 stocks that I track in my TradeStation scanner, 1,651 of them met my criteria for the high jump. Now, you notice what the number says, and let's pull up one on a chart. Let's look at, let's see if this is accurate or not. And I guess it really depends on time frame. Let's look at WLK. Let's go back to the last chart. Now I moved to a new machine here today, so I'm not totally convinced that everything is working right on this, but let's see. All right. Well, you can see that's perfect. So I think I've got the bar on set to be above 90% of your 200 bars in the back. So whenever you get, this is the high jump bar. If you remember, the high jump bar would take price and then take the distance between price and the 17-day moving average, the 50-day moving average, and 200-day moving average, plot it, and then tell what this chart here is doing is telling me a percentage of the highest high in the last 200 bars. And that scanner is going to pick up anybody that's above 90%. And you could see that WLK, or Westlake Chemical, I believe, was at 94% of the highest high jump. So bearish divergences at the high jump, these are things that you expect to ultimately roll over. And when you see on a scan, or when I see on a scan, such a high number of stocks meet these criteria, I'm a little bit surprised. But we've had a broad-based market run, and this market is toppy by many metrics. Now, another way I measure the market, and now you see some things that are perhaps less concerning, is various tools, whether they're in Edge Rater or they're in HGSI. One of the tools is called Group Performance Analysis, where I'm able to take a list, hopefully that wasn't a mistake, of hundreds of different groups that I like to follow and see what they performed. And I look from Friday to Friday, end of day to end of day, and I look up here and I see over that period of time what the indices did. I see the NASDAQ and the S&P 500 outperformed the small caps and the mid caps. I think Friday did some damage there. I can see that the top in black is much bigger than the bottom in red, so that the stocks that were in the bullish, that appeared bullish last weekend, many of those groups performed well. I look at the S&P 500, I see up about 1.21%. That tells me the S&P had a good week. I compare that to certain things. I compare it to the IBD 50, which did not have a great week, was up 0.54. But if you can get 0.54 every week, that's a great week. And the HGS 100 was up 2.22%. So it tells me that the types of stocks that I like to trade, high growth stocks, had a great week. The stocks that were in my buy list last week were up 2.79%. The ones I owned last Friday, doesn't mean I own them this Friday, were up 1.82%, which was about what my high beta stocks were up. So this tells me it was a very good week for high growth stock type investors like myself. Now, to those that are in my upcoming June session, I sent out my master list of stocks this week, and you can see the stocks that I picked and why I picked them. But all it is a watch list. I don't buy everything on the watch list. When you see a week when you have 47 up, 13 down, you make you feel good, but it just means we had a good week. And in a good week, you'll have more winners than losers. I could look from end of day, whoops, I didn't do this one. I did it, I just didn't put it in here. Opening of day, Monday to Friday. And, these just to show you how I do this, I actually save them as a HTML file, and then I import them into Excel, and that's how I like to save them. So here's the opening day Monday. So I did the same analysis from Monday to Monday, and the bottom line is you still have mostly black. You have a little bit more reds than you had before. The S&P is up 1.13, which is not quite as much. That tells me the market must have opened up on Monday, and therefore some of the gains from the prior Friday maybe came during that opening. So let me just do what I forgot to do before, and let me copy this, and let me stick it into my spreadsheet, because I keep a record of these things for internal use, as we might say. Okay, now it's in my Excel spreadsheet. Let me just save that, and we're good. I look for a Hindenburg. Now, for those that were on my call from the group this week, we talked about the Hindenburg, and that this is a signal of a top when the pros are selling it to the amateurs. So the institutions and hedge funds are selling to people like me that are amateurs. And when you see a Hindenburg omen, it should get you a little bit nervous. There has not been a major correction in the last 40 or 50 years that was not preceded by a Hindenburg omen signal. A signal is usually defined as multiple signals, and we haven't had a signal going back since middle of December. So we're all clear there, but I'll continue to monitor that, recognizing that one time you have a correction without, so it's not perfect, but it's something that puts me more in the less worried category. Another less worried category is we're clearly bullish on my buckets analysis, with over half the S&P 1500 above the midline. But when I look at how many stocks are above the upper band, I don't see a number of 30 or 40% that would suggest that we had a pause coming, not necessarily a pullback, but a pause coming. Then I look at the markets. These are all in Edge Rater, by the way. And what I really want to do is get a sense of what phase this market is in. So we're going to look over here. It's the Woody indicator from Ian Woodward, which is the percent B times bandwidth. Green is when it's a good time to be buying. Red is bear. Yellow is chop. And if you go back to, this is June of 2012, so really over 2 years, you see you get pretty well-defined periods of green. You get chop. You get some intermittent periods of red. So this was a long one from September of 12 probably to the middle of November. That was the last big pullback we had. So that was a 2-month period of chop and pullback. Here was a short chop and pullback, another short period. Again, this is a typical chop and pullback from March of 13 until April, so a month and a half. And again, another short period. So the market goes through these relatively consistent 6-week periods here, up 6 weeks, chopping down, up and down, up and down. And you get to where we are now. And the reason why it's painful is this chop started back in early March. And so it's been almost 3 months of this period, which is really double what we've seen. And it's been a tough market because you're not getting long trends. This is an easy market. Everything is moving up at the same time. This is also an easy market because everything's moving down at the same time. It's when you get this nonsense that we're living in, where you get short spurts and then back to chop, that's hard to trade. And I look here and I want to believe that the green is coming in and that maybe the market's firming up. But this might be evidence that we see a potential move up, the melt up per se. Now, I just want to point you down where my little cross is. This is the percent B. And just for clarification, I don't know if I got them up here or not in my little cut. Hello. You got S&P, the Dow, Russell, NASDAQ, utilities, all the different things that we might look at, the major indexes. And we look at them all together. They usually behave together, as you can see. And what might be scary to the bulls is that the percent B is up about 1 on all the major indexes, which means they're all at the top of the Bollinger Band. That might be a reason to be concerned. And then just to, a little bit of promotional mention, one thing that EdgeRater does is it automates a lot of the signals that people like George Lee use. I use many of these. Some are from David Elliott. There's a number of people out there, John Carter Squeeze. But we're able to put our portfolio or a large number of stocks, run them against, are you in a squeeze or not, and then monitor for specific types of breakouts. And that's an automated feature within EdgeRater. What I do on a weekly basis is I build my watch list within HGSI. I output HTML files. I import them into Excel, and then this is what I look at on a weekly basis on my different lists that I put together in watch lists that include things like the IBD 50 and the HGS 100 or so. You don't always get 100 stocks. And it's what I trade off of. It's sort of my cheat sheets that I use. And as I mentioned, I did stick it in the Dropbox for my June attendees. Let me close these up. So let's go into HGSI and take a look for some top-down approach. Go into the warehouse view. And before I get too deep into this, let me take a look at what my canaries are doing. So actually, this is fine. Let me turn off my index, or my filter rather. And let me go down and look at a couple of user-defined indexes. So the canaries, you can see what they are here. Normally I just put the chart up. The canaries are an early warning system for me, and it gives me an idea of when, what these types of stocks, which were the rah-rah stocks if we go back a year ago. And one thing we pointed out last weekend was some bullish stuff. You had probably a bottom in here. You had a PSER reversal. The canaries index broke above the moving averages. The 50 still did a cross under, but hopefully it's going to loop quickly. The Bongo weekly is still red, which is a little bit bothersome. But other than that, I thought that this was perhaps a sign of a breakout in these. And if you own any Netflix, you know that your stocks have done well. And the interesting thing is they're not all behaving the same. Let's just real quickly look at them. Tesla kind of looks like the index. Looks like a bottom, came in here on the 200, broke above the 50-day moving average, paused on Friday. Netflix, bull run, big run. As I said, I've got some calls that I bought back in this nonsense period, and I thought I made a mistake buying 320 calls when Netflix traded under 300. So I've had pretty much a 500% return on those. It's probably time to take my profits and be happy, but I'm going to wait for the chart to give me a signal. And look, everything is green. I had a pocket pivot on Friday. It has a little bit of a spinning top, so we'll see what it does on Monday. Apple, a lot of targets out for 700. It had a tough day on Friday, but still in a nice uptrend after its gap up. Priceline, there's a lot of stocks look like this. They pulled back, bottomed on the 200, now moving up. Expensive options, expensive stock, certainly giving some of the oomph to the canaries index. Facebook is one that I'm also long. Sold off hard. It's a little bit of a base action here. It too has broke above the 50. And we'll see if the 50 turns north before it runs onto the 200-day moving average. So the canaries have a mixed bag, Amazon being the one that's probably the sickest. And when I say sickest, I'm really referring to the fact that it's the one that's so deep below the 200 and below the 50-day moving average that has a lot of overhead resistance to get through and is pulling down the average. Google, I guess this is after post split to the new stock. A lot like Netflix, a big move up. It paused this week. We'll see if Google continues to run. Hence the canaries index, and then LinkedIn is the other loser of the group. What a great place to potentially short if it fails at the 50. And if this market fails, this is one of the ones that I love to short because look at the history of failing at the 50. So I know where I can set my my stop, and we'll see what this market does. If the market trades up a lot, LinkedIn will get carried with it. But if you're looking to build some short candidates, shorting it at the 50 has worked going back for months. All right. The other one I want to look at was the LLUR index, which is on a larger number of stocks. This is where the leaders back in March. And this index really hasn't broken, even with the pullbacks we've seen. And it's pulled back to the 50 several times. Had a tough day on Friday, as you could see, the big red day. But if you're colorblind and you can't tell that it was a closed day, it stopped right above the 8-day exponential moving average. I'm still very bullish on this list, which is part of my thoughts of, how extended is this market? You've had a big pause on the high flyers. Maybe there is room to run again. All right, so first thing top down I do now is I go into the program and go into Ron and Ian's group, or Woodward and Brown groups. Major Markets Plus, I use the T1. Whoops. And the T1 is a all technical, mostly weighted to the last day in the last week, but does have a Force 13 in it, so it does look back 2 or 3 weeks. Strength in the Dow and the NYSE, utilities are still strong, weakness on silver and gold, commodities volatility. If you look at 5-day performance, the semis had a great week, as did the NASDAQ 100. Transports continue to lead. Volatility has been crushed. We'll look at that, as has gold and silver. Dollar, we'll look at the dollar in a few minutes. On Friday, volatility, silver, commodities hurt the most. The Russell probably the most to the downside of the stocks, and we'll look at that and show you the evidence of it rolling over as well. Let's go through my favorites. Let's look at the S&P 500. We see there's no Eureka for the week, so I'm not going to worry about that. Let's go into this view, which is easier to see. This was my line here of resistance from the weekly charts, and I was waiting to see whether it breaks above or it pulls down to support, would support hold, or will pull down to what might be the next level of support. So what's happened? We've broken above. So we've broken above resistance. There's no moving averages or anything sitting here. There's nobody that bought the S&P up here that's just waiting for it to come back. What would a melt up look like? Let's see if I can find one. When it won't last for years, but to me a melt up is when you'll have one, and then you'll slope, and then you get a massive increase here, almost vertical to a top, and you sell off. And when I look at this on a weekly chart, I don't really see a vertical move yet. Maybe this is the beginning of the vertical move. So we kill those lines, because those lines don't matter anymore to me, because we've broken through the support. That's a beautiful looking chart. If this was a stock, we'd be very bullish. It's starting to move away from the 200, which is why the high jump might be an issue, but certainly up above the 8 to 17, 15, 200. Got to be bullish when I look at that, except for the fact that eventually it's going to stop. If I look at the NYSE, which has a lot of things in it, a lot of junk too, to be honest, but really a good representation of a broad market. Big up move going back to June of 2012, so for 2 years, and we continue in that up move, and has not violated on the weekly the 50. And if I look at the daily, you could see, like the S&P, a slow rise, and you could almost argue some sideways basing for the last couple of months at a multi-year or all-time high. If I look at the NASDAQ, well, that's the NASDAQ 100, but let's look at the NASDAQ. The NASDAQ was in deep doo-doo and pulled back to the 200-day moving average. I'm very careful. Gil may have patented the term deep doo-doo, so I won't say that. Just kidding. But you saw a 10% decline in the NASDAQ. You've got the 8 crossing the 50, the 17 about to cross the 50. The stock above the moving averages, or the index, also looks very bullish. and not overly extended. So maybe do have some more room left in the NASDAQ. The one that worried me from this weekend from the indices was the Russell, where the Russell looks like it's failing at the 50-day moving average. Now, the Russell may bounce in this area between the 50 and the 200, and I guess the Russell may be, range bound until it breaks above, bullish, or below that 200. You want to see what's ugly. Let's take a look at gold and silver. We'll start with silver. Are we getting to a selling climax? We had huge volume on Friday. Closed a look probably above the midline of the channel on a down day. Who knows? All I know is it's way below its moving averages and has a long ways to go before I'm going to be bullish on silver. What about gold? I know that's not gold. I hit it too soon. Similar story, big volume, although not perhaps as much volume. I bet if we look, there's probably a pocket pivot down, whatever that means. Pocket pivot down, big volume, everything's red on the technicals that I look like. Gold don't look very pretty to me right now. On that, it's saying that when I looked at some gold stocks and some stocks like AEM, they didn't look as bad as the underlying metal does. So I think I'm still bearish metals, but at some point I expect them to rebound. Dollar. Dollar was running up, but dollar's in a downtrend. It's below its 200-day moving average. It continues to fail without breaking above it. If we look at a weekly, the last time it broke above the 200 weekly was July of 13, and the last time we broke above the 50 weekly, which is kind of close to the 200-day moving average, the 250, goes back to September of 2013. So this is a downtrend. And it's not at the bottom of the channel, but it's pretty darn close. It's interesting to me that gold and silver are so weak with the dollar being as weak. And then we look at volatility, and this is my whack-a-mole that every time it's popped its head up to the 200, it gets whacked down. And we're not at, we're probably at a closing low. Let me just, for the fun of it, that is a weekly. Let me do this. I'm going to hit my shift button. Come on, that's supposed to, hold on, let me figure out what I did wrong. So we're basically at a closing low, a multi-year, or at least a 1 year. That's a closing low back here, kind of where we got in 13 in March. And we go back and let's see, what was that number? About 11. So we got the line there. I guess we're going back to 2007 from the perspective of the volatility, and we know what happened after 2007. This is market in turmoil. All right, so the VIX is very low, and I make money when the VIX is falling. I can make money when the VIX is flat. I don't make a lot of money being long when the VIX is rising, and I think that to me is the risk of us getting into. If I look at the industry groups, I see that because of the Bloomberg groups, we now have 196 industries. If I look at force up, kind of even split, we've got 44 to the upside with force. Remember, force looking at price change and volume. Force to the downside, we got 45, so kind of similar. Personally, I'm still learning these new groups. Sometimes I miss the old groups, because I have a history, but I do recognize on these new groups that they're much better from breaking out. Like midstream would never have had its own piece before, and midstream has been one of the leaders. So first, let's take a deep breath and look at what we got here. We've got a lot of REITs. REITs. Not a shocker because REITs are dividend payers. We have a number of energy services and midstreams. We got the midstreams here, oil and gas services, which I like a lot this week. I got refining and marketing. I've got tobacco, which is clearly a dividend payer, and a number of utilities, which I'm not really that excited about. So let's put the raw combo, and let's take a look at who the leaders are by raw combo. So these, I don't know the story here, so I'll show you the trick of how I find out the story. I'm starting with Cheniere Energy, and obviously a big power move in this, and it's next one I'm going to show you. So I see this, pocket pivots, kahunas, huge volume, everything is green, a Bible gap up on Friday. It's got to be a fundamental story change on these LNG plays. So I look here, it doesn't pay a dividend, that's not the answer. I look up here, natural gas distribution, okay. So I'm wondering if the government didn't have some noise about allowing the export of liquid natural gas, which would, I would think, bring a lot of business their way. So we'll look at Yahoo. So all I did was right-click, went to more info from web, left-clicked on Yahoo. It brings it up with the ticker, and let's see. So it is. There's discussion about LNG exports, and so the export terminals are going to be big victors of that. So here's LNG, Cheniere. Now, is it too extended? It's your own call, but you have a Bible gap up. You had huge volume the day before, kahunas, pocket pivots. I want to know more, to be honest. I look at Cheniere Energy Partners Limited Holdings. It looks the same, maybe even more pronounced. Again, what's the difference here? Teeny weeny dividend. I probably want to do my own research, but it looks like something's happening with these stocks. Enterprise Partners LP, not extended, so it's been a nice uptrend, sideways consolidation. Multiple pocket pivots and kahunas. Mobile breakout from a squeeze. Everything is green. It makes money, and it pays a 3.8% dividend. That looks like an interesting play. Williams Companies, I think this is a MLP. Midstream oil and gas, natural gas transmission. Everything's green. A lot of these have had a big run, which is the problem, and they pay a 3.4% dividend. There's the index. So I found a number of these, and I'll look at my buy list before we say goodnight. But one place you might be looking if you want to play this market is in these midstream oil and gas plays. Sorry about that. I did not want to do what I did. I'm going to kill all those. Go away. Thank you. All right. When you make a mistake, you get taken to the industry groups above, and then you got to go back into 05 here to do this analysis right. The next one was Food Manufacturing Index. It was funny, when we did our meeting in Palos Verdes, we were sort of interested in why the chicken makers were up there. Hillshire Brands is probably driving this. This has been a takeout play with multiple competing companies. You could see how wonderful this is if you were long it. It had one buyout bid here, and 2 days later it had another buyout bid. I don't know how you play this. You see the volume that came in. It probably goes higher on a bigger bid. I'm not playing. Tyson, I believe, is one of the companies bidding for them. I think this whole sector I'm a little nervous about because of this takeover. Boring story, Mead Johnson Nutrition, but look at that. 4 kahunas in the last 5 days, a big pocket pivot, breaking out from a squeeze, everything is green, and it pays a small 1.7% dividend. One thing I did notice was that these expensive stocks were some of the ones that were leading. Sanderson, another one I think that's in that takeout battle. All right, what else? What other groups are working? Mass merchants. So Big Lots was up 13% on Friday. I don't know the story. but I probably want to know the story. So big Bible gap up, mobile breakout from a squeeze with a Bible gap up, kahuna, massive volume. Had a pocket pivot the day before, but it was below the 50, so I probably wouldn't have paid attention to it. I don't like its earnings story. Why did Big Lots go crazy on Friday? Trump's first quarter, so it beats on shares. That's the kind of thing I like. I love what Bespoke calls triple plays: earnings beat, revenue beat, raise guidance. So this might be one to look at. That looks like a substantial change going on here. And when you put on the weekly chart, it's sort of been in chop. Is it breaking out of here? I don't know. But you're not buying something that's super extended and long gone. And from a dividend perspective, there is no dividend. So Big Lots probably pulled everything up. Target below the 200. Next, I'm not interested. Walmart, probably not too interested. It doesn't fit my style. Below the 50, I'm not that interested. We'll go to the next group. And I'll go through the top 10. Telecom carriers interest play. Probably not a big fan of Sprint, but I am interested in Verizon and AT&T. So here's Verizon, and I'm interested in for a simple reason. I'm retired. I got some cash. The bank wants to pay me 0.5%. I look at a weekly run of Verizon, and its pullback looks like maybe it wants to break out. Here's the group strength. But the real reason why I'm interested in Verizon and AT&T is it pays a 4.2% dividend. And if I go down to AT&T, which has had a little bit more of a pullback here, but to the 50, it's not broken, pays a 5.2% dividend. So this is a group that I think is being driven by the dividend play. And if I'm looking for dividends, I'm interested. I've said over and over again that pharmacies are going to be winners in Obamacare because of the increased number of people being able to buy drugs. The three in this country are Walgreens, CVS, and Rite Aid. Walgreens is an interesting play as they've made some great acquisitions in Europe. They also have an ability to buy out AmerisourceBergen, where they now own 35%, so they would control the entire distribution channel from manufacturer to patient. They've got good earnings per share growth, clear uptrend. You're buying them as they're breaking out from here. Everything is green, pays a dividend of 8.8%. I think Walgreens is really a nice play. CVS Corp, very similar, had some pocket pivots, doesn't have the same earnings per share growth. They don't necessarily have the same story on the distribution side, are more a pure play, both a pharmacy and specialty pharmacy and benefits management. Oil and gas services, I want to point out a couple of these. Here's the index. I like to look at what's above the index, and I'm impressed that so many of these stocks are above the index. So if you look at them, and they're all different, the big granddaddy is Halliburton. It's a big position of mine and a long-term position, so not really my trading account. And the reason why it's a long-term position of mine is it's been in a long-term uptrend ever since December of 12 when it broke out. As some of the Horizon stuff from, I guess it must have been here in 2011, and the BP stuff started to resolve, the stock started to behave. It's in a massive bull run as far as I'm concerned. It has great earnings per share growth, pays a teeny-weeny dividend of less than 1%, which they could do better on, but it's in a strong group. It's a leader in the group. Weatherford is one that, what got me interested in Weatherford is, it's a little high base maybe here, a couple of kahunas, a pocket pivot, everything is green. It's got great earnings per share, and it's one of these box 7 type stocks that stubbed its toes, and now it's starting to have some earnings growth come in. And if you look out at the next 2 annuals, it's very impressive. Also on the list, Schlumberger, we're going to skip that one. Let's take a look at Basic Energy Services. I don't like that it finished below where it opened, hence a red candle. It did have a pocket pivot because it was up for the day, had a kahuna the day before, great earnings per share growth, so another turnaround play. That one captured my interest. And I don't get this one. obviously a bottom fish. It's against everything I've ever said, but there's a big turnaround coming into Rowan with earnings. If you take a look at MarketSmith or something, you can look out the next 2 or 3 years. But what really got me interested is look at the volume on Friday, a pocket pivot, massive volume. It's way below the 200 and probably not something that would fit anybody's rules to buy. But every once in a while I do some bottom fishing, and this is something that intrigued me. It makes money. Sometimes you just take a flyer, and to have a small percentage of your account speculative, there's nothing wrong with that. But one thing that I've learned, and to me I wish somebody would have taught me a long time, is you've got to find a way of identifying what you're buying off of a chart, and you have to treat that different than an investment. And you can't get married to these beaten up bottom fishes. You're buying them for a quick pop. They're going back down eventually. They're not stocks that you're usually putting away as mattress stuffers. And I think it's important that you remember to differentiate those. And tobacco, very strong. Why? Well, you know why. It's not because more people in this country are smoking. In fact, the big hullabaloo now is about how liberal we should be with e-cigs. Multiple kahunas, strong uptrend, everything is green. Lorillard pays a 4% dividend. Altria pays a 4.6% dividend. Philip Morris pays a 4.2% dividend. Reynolds American pays 4.5% dividend. Do we wonder why people are buying tobacco stocks? No, they're buying tobacco stocks not because they are necessarily pro-tobacco and anti-human being. They buy them because they need the dividends. I'm not going to spend much time on utilities. Utilities made the top 10. Large pharma. Interesting, I can tell you at ASCO, it used to be ASCO was about little companies that you never heard of before that had one product, and everybody was getting excited. They presented the paper, and the stock would move 30 or 40%. I think the big papers we're seeing here are coming from Merck, BMS, Pfizer, privately held Boehringer Ingelheim. And although you got Peregrine here and Celldex and a lot of other small companies, some of the big noise are coming from the big guys, which means it probably doesn't show up as much in their stock. That said, here's Merck, sideways consolidation, pocket pivot on Friday, kahuna on Thursday, mostly green above, and guess what? Dividend of 3%. Here is J&J, sideways consolidation, big move up on Friday, multiple kahunas in the last 2 weeks, everything is green, mobile breakout from a squeeze, 2.8% dividend, and BMS not as attractive as it's still got to get above this bearish cross of the 50 and the 200, but a 2.9% dividend. I think the theme of dividend interest paying should be pretty clear to all of us, that that's one of the strong things. And then the other thing that was strong, and I guess these would be consumer staples. Are these not the world's most boring names? No disrespect to anybody that works there. They're not typical growth stocks. Here's Colgate-Palmolive breaking out to new highs. Pocket pivots, massive volume, kahunas. Did they have earnings come in? Nope. Now, they're worrying about a major announcement. All right, so maybe they're going to buy something. Bottom line is, pays a 2.1% dividend. How about Procter & Gamble? Trying to get above the 50. It's not there yet. Pays a 3.2%. Kimberly-Clark, I like this one. Big sideways consolidation off the 50-day moving average. Multiple kahunas. Everything is green. Had a mobile breakout from a squeeze on Thursday. Pays a 3% dividend. I don't think in all my years of doing these, which is probably going back 5 or 6 years, I ever saw Kimberly-Clark come to near the top of my list. So maybe it's all because of the Clorox takeout that we've been hearing about with Phil Mickelson. Going down the rest of my list, generic pharmaceuticals, lots of REITs, refiners, more REITs, chemicals, auto retail stores. And I don't know why Hertz is here, except I guess they sell cars. But I love this chart. This is Advanced Auto Parts. Let's look at it on a weekly chart first. This is a stock that's had been a big growth over the years, going back in 2010 from 50 up to 126. So in 4 years, it's gone up 2.5 times, essentially. That's a pretty big movement, averaging 50-60% per year then. It makes big moves and then it consolidates. It's been consolidating. There's the weekly. It's pulled back here, as you could see, gradually at the 50. It had a mobile breakout from a squeeze on Friday, a pocket pivot in a kahuna. And when you consider the strength in its brothers, here's O'Reilly, mobile breakout from a squeeze, kahuna and a pocket pivot, the same type of a pattern. Again, I don't know why Hertz is in here because the earnings are coming. Here's AutoNation. Here's AutoZone, which has been a great stock over the years. Something's going on in the auto parts world, and it might be something to keep an eye on. On the downside, and I'm getting tired, and you're probably getting tired of listening to me, on the downside, let's see if there's any standouts that I wanted to point out. Biotech had a nice run. I think you watched Gilead. I've said it before. This is the one that I thought and still think will be the Celgene of this year and next year with the big growth. Why do I think so? Because I'm an earnings hound, and they've got great earnings growth coming into this company. They obviously are under an assault because of their pricing of their Hep C drug. As someone in the industry, how can you blame them for trying to maximize their return? They started to stall on Friday. They had a PSAR reversal and a pocket pivot to the downside. So I'm a little nervous, and I think how Gilead goes is how biotech's going to go. And I do seem to think that seasonally this is a tough time in the marketplace for biotech. The other one to take a look at or to keep on your mind is Biogen IDEC, which I think was up, so it won't be here. Let me just show you. This is probably the leader in orphan drugs. Got some cancer drug revenue as well. And they broke above the 50 on Monday. And if they can hold that, then that also bodes very well for biotech. Everything turned green, and that's one to watch as well. They had some pocket pivots in the last week. Anything else for me to point out? Interimmune's an interesting story. It's got a drug that's ready to get approved by the FDA for pulmonary fibrosis. And then one that we were talking about a little bit on the board that I have some ownership in is Merrimack, which has a drug for pancreas. This was sort of a wild card of mine coming into ASCO. We'll see more of their data. You could see it's had a big run up, and I haven't heard their data yet, so that should be a big mover for this stock. They have a treatment for pancreas cancer, which the early data look pretty promising. So that's what I do for top down. I look at what's working on the long side, what's working on the short side. You can see other places where weakness, specialty pharma, casinos, steel producers, base metals, semiconductors, the banks. When I looked at about 600 stocks today to try and build a buy list for me. See if there's anything here I want to point out of what I liked and why I liked them. Targa Resources is in the same family that we looked at in the midstream oil and gas. And so NGLS, it's in a nice run, multiple pocket pivots. Everything's green. It had a mobile breakout, whatever that means, on Friday. Great earnings per share growth and pays a 4.5% dividend. Lanet is a generic drug company that was a favorite of ours over the last year as it ran in September from 14 up into the 40s. It sold off hard down to 32 or so. I think it's running again. I got long into it early in the week. It had a nice week last week, although like many things it struggled a little bit as the weekend. Look at the earnings per share coming into this stock. I'm not a REIT buyer. I have some non-traded REITs that pay a hefty dividend that I'm in, and the reason why I'm in them is during the 2008 and 9 market tumult, Since they're non-traded, they didn't look like they lost 40 or 50% of their value. In fact, those that I have maintained their value despite that. If I'm going to apply stock patterns to them, here's one I like. Sovereign Self-Storage. A number of the self-storage companies made my list or made my review. Everything's green. Mobile breakout from a squeeze. PSAR supporting. Had a pocket pivot on massive volume. And oh, by the way, it pays a dividend of 3.5%. Clearly, dividends are a theme this week. Omega Healthcare Investors. I've been watching this going back months. When it broke out here, I was surprised by its yield. Still looks damn good, and it pays a yield not quite 6.1, but 5.4%. Activists, I think, will be a leader when this market decides to go forward, but that's just my opinion. You don't buy it on my opinion. I'd keep this on your watch list looking for a breakout from here. But right now, it's still going sideways as far as I'm concerned, so I'm not buying, I'm watching. I mentioned packaging companies. Similar pattern, in fact, if all we're looking at like this, it looks just like activists where it's trying to find its way. But several of these packaging companies did this. They broke out above their 50 on Friday. They have earnings per share. Some of them have a dividend. Here's 2.3%. On a pocket pivot, that looked interesting. NPS is potential buyout play. Walgreens is in a buyout mode. GPK is another packaging company. A number of payers also made my list. And as I looked at them, the one that I was probably most intrigued by was United Health. They're doing some innovative things. They're switching their model from taking risks to providing services, which I think long-term is a good thing to do. Clearly a leader. You can see the group strength breaking out above the 50 with multiple pocket pivots. Everything is green. Don't love the fundamental story. There's your Kimberly-Clark and Weatherford. Their Halliburton. Here is an example of why some of the banks interested me. It looks like it's put in the bottom. So this one's, I'd rather buy it breaking above the 50, but it's mostly green above. Mobile breakout from a squeeze, a pocket pivot, volume, and a kahuna. So again, more info from Webb. Let's just see if it came out with earnings this week or something. I don't think so. Well, I'm kind of curious what's going on here because if it can break above the 50, it's going to flip its PSAR and have multiple reasons why I want to buy it. It's got good earnings per share growth and it pays a dinky dividend less than 1%. Added in this list of bank stocks that intrigued me was Wells Fargo. Much nicer looking chart, lower left, upper right. Looks like it wants to go again. Everything is green. And then U.S. Bancorp somewhere on my list as well. I think U.S. Bancorp. I can't. Yeah, here's U.S. Bancorp. Kind of like a combination of the two. It's broken above the 50. Everything is green. Not much in a dividend play, 2.2%. They actually benefit from rising interest rates. All right, I think that is enough. These are the ones that intrigue me for various reasons. What else can I do for you? I can look real quickly at a GIF, which I did earlier today, so I'm not going to repeat it. These were my GIF All-Stars, so let's run through them. This is the group inclusion report. These are the stocks that made it on the highest number of my bullish leader list. Air Lease Corporation. I haven't looked at any of these necessarily. Certainly looks like it's breaking out. Multiple pocket pivots, volume coming in, everything is green. Had a Bible gap up 2 days ago. It makes money. It pays a nothing dividend of 0.3%. It might be like AER, which has done well. Eris sold off a little bit after their earnings. Been a beautiful move. Leader, everything's green. Multiple pocket pivots last week. I've been in and out of the stock. I want to be back in. Avis Budget Group. It and Hertz have a nice lower left, upper right move. Clearly been a leader. Everything is green. Centene is another payer. This could be a choice. It's certainly in a nicer run than United Healthcare. Everything is green. They do a lot of work as a Medicare, Medicaid HMO. China Plastics is one that Ron spotted with his shadow stocks list. Had a huge run pullback. Looks like it wants to run again. Ignore these numbers. Go look at a different resource, and you'll see that China Plastics, if it meets its earnings, is probably making a lot more than it should for an $11 stock, which I think is why it's exploded and doubled in about 2 months because of the earnings potential. We mentioned drugstores. Here's CVS. Diamondback Energy is one of my favorite energy plays, and not just because it's called FANG. Great earnings per share growth. Sideways, let the 50-day catch up. The extension goes away. You had pocket pivots. I think it's going to run again if this market holds up. ETE is another high dividend paying, not high, 2.8%. Extended, nice run. Energy play, another midstream oil and gas, natural gas transmission. Gentherm is an auto parts. It was a leader a few weeks ago, sold off on Monday. High Crush Partners, I believe they have something to do with fracking. The group that they're in is the other mine minerals, sand reserves, and I'm sure they provide sand for the frackers. 4.2% dividend, nice run there. Lanet is that drug company we looked at. Magellan's another midstream. Michael Kors is probably one of my favorite retail plays. I've actually am sitting on some calls that are right at the money. It had good earnings. It felt move up. It went down. Michael Kors has done better than Coach. I'll probably take my money and run because I just don't know if it's going to turn around anytime soon with our sluggish economy. Micron's been a great leader. We've talked about it multiple times. Pilgrim's Pride is one of those chicken and processing companies. That was one of the groups in the top 10. Questcor, careful, this is a part of a takeout. I'm not sure how much its individual movement's going to matter because it's getting close to takeout time. Sanchez, I have BCEI. I own BCEI, which looks the same way. There's been some, not necessarily M&A activity, but moving around of properties that have caused some nice jumps in these stocks. BCI as well did the same exact pattern. Sanderson is again in the same group as Tyson's. SanDisk, hard for me to buy this stock with the negative earnings growth coming, but what a leader. How many things do you have that say SanDisk? Your SSD drive in your computer might. Certainly the SD card in your camera, in your cell phone. We all use their chips in our iPad perhaps, and they've been on a big run, a leader. Skyworks, not as extended per se, but the high jump's pretty high. Did have a couple pocket pivots this week. Southwest, I own Delta. They slowed up this week. I'm getting worried about Delta being toppy, but they've been lower left, upper right winners. Trinity and the train group, transports continue strong. Think Trinity, think Greenbrier, think American Railcar, think the railroads. They've been big leaders in this run, mostly because of the use of them for transportation of fuel. If you want to know a reason why you have the economy improving, a signal would be the transport's doing well. Speaking of trains, Union Pacific, certainly one of the leaders on the train side, pays a 1.8% dividend. And then United Insurance we already looked at. And then Valiant is, I own some. I lightened up my position with all the muck going on with their takeout of Allergan. I'm an earnings hound, and even without Allergan, they've got some great earnings per share growth. They do some things that are questionable from the perspective of acquire companies and grow by taking out costs, reducing R&D, getting a better tax rate, but who cares? All those are legal and they all work. What I like about it, on Friday, it looks like it might have had a reversal day on the 50 with a pocket pivot, huge volume, and everything turning green. And that's it. So I'm losing my voice. So that went longer than I expected. I'm using a different computer and format tonight, so I apologize if the system doesn't come out right. Those that are coming in in June, you'll be getting an invite later for our Thursday night call, and I hope you'll have a great week. I think this is a week of indecision. Indecision equals risk, but it can also go up. And just for completeness sake, where the futures right now, and the futures are kind of, they're up, but they're not up much, so they'll change back and forth as the day goes on. But we're certainly not starting off really low. So good night, everybody. Have a great week. And I'm going to do a live program on Sunday night coming up. My wife's out of town, so it's just me and the dog, so you'll get an invite. Good night, everybody.